Hello and welcome back to Core Finance with me, Matt Brown. I'm joined by Campbell, market analyst at Spreadex. We're going to talk about a few UK-based stocks this morning. Starting off, Petrofac, well, down she went a couple of months ago. Had a little bit of a bounce. I mean, maybe a dead cat bounce, but what's your view on this now?
Yeah, obviously at the start of the year, things weren't going too badly for Petrofac. Its full-year figures suggested a company in the midst of a turnaround. It's managed to eke out a net profit of $1 million, which doesn't sound like a lot, but that was compared to a $349 million loss the year before. So, you know, signs of progress there. Full-year revenue was up 15%, doing quite well, chugging along nicely. Then May hit. The Serious Fraud Office announced that they were investigating the company, I think due to bribery and corruption and money laundering charges, so, you know, a nice trio of issues there. That was related to the SFO's investigation into Unit Oil, which is a Monaco-based firm. They did some consultancy work for Petrofac, I think, between 2002 2009. So obviously that was the first, you know, wave of losses at the, you know, mid-May. Towards the end of May, then they suspended their COO. Obviously, investors sort of balked at that news, and that was signs that, okay, maybe there is something, you know, going to come of this investigation. That sent it to 8-year lows in around mid-June. Since then, like you're saying, it's recovered sort of. It's pushed back around that 450 mark. That's largely due to a string of decent contract updates. Most recently, it secured a $2 billion deal in Oman. So things like that have sort of reassured investors somewhat that, you know, companies haven't been put off Petrofac. They are still willing to do business with Petrofac, and it is still securing chunky contracts, you know, for its next set of figures. However, you know, half year on Wednesday, the big news is going to be any update on the SFO investigation. They recently hired a top city lawyer, I think Edward Sparrow's his name, to sort of deal with this issue. So any update on, I don't know, maybe a timeline. A timeline would be good. A timeline to say, okay, well, this is when they think the investigation might end. These are the sort of the key dates in the next coming 12 months, really. Whether Petrofac is in a position to actually deliver that, I'm not sure. In terms of its figures, I think revenue is expected to be down around 11%, but earnings are expected to be up 2.6%. So, you know, 50-50 toss there on how investors react to those figures, really. From our clients' perspective, they've been buying around that £4 mark, £4.50 mark. Obviously, there is a lot of risk attached to Petrofac at the moment, because if something does come off that SFO investigation, there is plenty more room for it to fall. On the other hand, however, if nothing does come of it, or if what does come of it isn't as drastic as perhaps that fall in May suggested, there's plenty of room for it to climb. So I think our clients are taking a risk on that and buying around the £4 mark.
Okay, so look out for the update on Wednesday. Moving on, Hayes, the recruiter, performing actually quite well.
Yeah, given it's sort of the last three updates, Hayes' main three updates this year have sort of painted a similar picture. Back in February, it's half year figure, I think. Net fees in the UK were down 10%, obviously Brexit related, and the 6 months since the referendum, there'd been a significant softening in the UK job sector, especially in the private sector, which I think comprises maybe 72 to 75% of Hayes' net fees. However, elsewhere, it still managed to eke out a total net like-for-like net fees growth of 3%, pre-tax profit was up 17%, and it hiked its dividend 5%. So that sort of sets the tone for Hayes this year, really, that whilst things are softer in the UK, its position elsewhere, especially in places like Germany, is strong enough to counteract that, really. Similar situation in April, it managed a record quarterly performance of net fees, despite UK like-for-likes falling 4%. Again, in June, its fourth quarter update, like-for-likes in the UK were down 5%. It said that there's sort of no long-term plan for UK companies at the moment. In the next 18 months, they're so focused on the Brexit negotiations and the outcome of that they're not really taking the long picture. So that is going to continue to sort of harm the UK arm of the business. But it still managed to eke out a 7% rise in total like-for-like net sales again. So it's really got a solid position in the rest of the world to overcome sort of its. I think the UK section's at around 25% of its business, so that's, you know, there's plenty of room for it to recover elsewhere. In terms of this week's figures, I think it's expecting. I think analysts are expected around pre-tax profit of around 210 million, which would be a 16% increase year on year. Hayes said in July, however, that it expects those figures to come in higher than that. So I think investors will be looking for, well, how much above that 210 million mark does it come in? Our clients have been buying around the 170, 172 mark. I think, Hayes is doing very well. It's shown in the last few months that it's got the ability to withstand the softening in the UK, and there have been signs of improvement in the UK steadily, from the 10% to the 4% and 5% range. And it said that whilst there were still issues in the public sector, there were very slow, minor signs of improvement in the private sector. So that's again something investors will be looking out for with the full year figures on Thursday. Any more signs of improvement in the UK private sector?
Fantastic. And finally, Restaurant Group, been out of favour of late, not the flavour stock at the moment, but yeah, Restaurant Group, just briefly, who do they own?
Frankie Benny's, Chiquito, Garfunkel's, basically any chain store in London that tourists go to instead of looking up a nicer restaurant, basically. It's sort of been all over the place, really. It's seen some really, really big movements after its sort of updates throughout the year, regardless of whether they've been positive or negative. In January, it saw a huge plunge because it said that fourth quarter like-for-like sales were down 5.9%. Cut to March and it saw a huge jump, despite, the sales figures hadn't improved or anything, but it maintained its dividend, crucially, and it announced a turnaround plan. I think the turnaround plan was cut prices in Frankie Benny's. I think they're going to take items under £10. There were 5 of those on the menu, now there's going to be 22 of those on the menu. They're going to, cut their losses at sort of loss-making sites and increase their presence in UK airports, which again is the kind of place that what you're getting in a UK airport. You're going to just go there if you're sort of a bit groggy in the morning before your flight. Again, though, it's struggled recently. In May, its figures were fine. Like-for-like sales were down 1.8%. That's an improvement on the full year 3.9% like-for-like sales. So there is some signs of a turnaround there. However, you can see it's fallen quite significantly in the last few sessions. I think that's because analysts are expecting a 30% fall in pre-tax profit on Thursday, which, that's an ugly, ugly figure. I guess the only thing to say is it's fallen so much in the last few sessions that, say, if it comes in at 29% or 28%, there is room for it to bounce. Our clients aren't particularly interested, though. They're selling around that 330, 320 mark. I think that it might be going through a turnaround, but our clients aren't willing to sort of see how that goes in the next few months, really. I think they're looking to cut their losses and sell around that 330 mark.
Okay, no appetite for the stock at the moment. We'll look out for the numbers. Connor, thank you very much for joining us today.